How to know if the company I am thinking of investing in is a good or bad dividend business. I'm going to share with you a bare minimum checklist that I go through before even considering a dividend stock. We will be using VICI as an example. Why VICI? Because hey, we just crossed 1,000 subscribers, and I gave my word to one of you that I would make a video on VICI once we do so. Also, you didn't ask, but I just moved into a new house, so my life has been a little chaotic. There's boxes everywhere, and I can't seem to find anything. My first night in the new home, we didn't even have power, and it was around 35 degrees. It felt like a nice little camping trip out in the woods, except I couldn't feel my toes in the morning, and my water bottle next to the bed was frozen. Anyways, back to the video. First and foremost on this dividend checklist, I asked myself, do I understand the business and the industry the company is in? VICI does real estate for primarily casinos, golf courses, resorts, and other entertainment properties. They're in the business of partnering with experiential companies in which they pay a monthly rent to VICI in exchange to use the location. VICI requires a company to sign a long-term lease so that VICI can reduce the amount of vacancies that pay no rent. If they know and can forecast that a business wants to move out in 6 months, that gives them 180 days to fill that spot with another business as soon as possible. I would say VICI is a competitor to EPR, which is another experiential REIT that I made a video on. Understanding the business is my first line item on the checklist because if the business is too complicated to comprehend or the industry is out of my comfort zone, I won't be able to fully analyze the intangibles of their growth. No matter how sweet a company looks on the surface level, if you don't get it, think twice and think hard. Let a fart slip out and take a deep breath. A Wim Hof type of breath. Actually, please don't do that. That sounds like a hot mess. There are a lot of great businesses out there that I simply cannot understand, so I don't bother investing in them. I am a loser like that. Just like how there's some people out here who believe Chinese stocks like Alibaba and Tencent are actually undervalued, so they jump in without understanding the implications of the CCP. Yuck. Next, we want to know what the company's story is. Is there a future for them? Will they shine in 10 to 20 years? As dividend compound investors, we don't care about the next 3 months or even 6 months. We think, plan, and strategize long term because that's how our investments will compound and shine with time in the market. Now, VICI is making a huge bet on Las Vegas and prioritizing land development on their 33 acres in Las Vegas. Their website has Las Vegas all over it. So will Las Vegas be relevant in a decade or so? Will traditional casinos continue to be a reliable form of revenue? Here's a snapshot of their portfolio. So VICI currently has 54 casinos across 15 states in the US and service over 60,000 hotel rooms. They also own a huge portfolio of 34 bowling alleys across the country. You either believe in them or you develop a lot of doubt. After getting to understand VICI's business model, you can see how the pandemic disrupted their entire world and portfolio of clients. Their portfolio consists of wants and not needs. You don't have to go bowling on a Tuesday night or to the casinos unless you are addicted, like a middle-aged white female in Starbucks, or watching Fox News and getting angry at 8 p.m. You do you, whatever floats your boat. On an anecdotal level, I know a few friends who moved from Los Angeles to Las Vegas during the pandemic because of the cost of living and real estate differences. Actually, not even a few friends, maybe like a dozen or so. Perhaps Las Vegas really is on the up and up. However, something interesting, whether or not you brush your teeth or you believe in global warming or not, Las Vegas is the fastest warming city in the US. I actually had the chance to visit Las Vegas back in July of 2022, and I can tell you that Vegas heat is not a joke. It's really freaking hot in Las Vegas because it is a desert climate. For someone like me, I run warm, and even in the winter, I actually sleep almost butt naked. And I could never live in Las Vegas where it is near or at 100 degrees for a third of the year, unless you like sweating as a hobby and your butt crack being home to a swamp. Speaking of a swamp, has anyone actually tried fried gator tail before? If you have, what's it taste like? Is it worth the experience? Next, I look at the dividend payout ratio. ratio to figure out the sustainability of the dividends. If the payout ratio is too high, that dividend is saying bye. You may hate me, but it ain't no lie, baby, bye, bye, bye. Alright, since this is a REIT, we're calculating the payout ratio from the AFFO. Watch my video on calculating payout ratios to see why. The payout ratio for VICI is 77.9%, and for a REIT, that's actually acceptable. Seems normal. What I am looking for in a payout ratio is a number that is similar to the industry competitors. Regardless of industry, if the company has a payout ratio above 100%, then that's no bueno. Ideally, the lower the payout ratio number, the better it is. And regardless of industry, if it has a payout ratio above 100%, then that's no bueno. Like rolling the dice and ordering something you've never had before at a Thai restaurant. My goodness, will the food taste delicious, but your butthole? Yeah, your butthole will be breathing fire. Whenever the server asks you how spicy you want your food, if you want to live to see the next day, just say mild or non-spicy. By the way, if you've never tried Thai food before, their green curry slaps. That is my recommendation. Try it out. So this YouTube channel is called Dividend Compounders with Cheese. We like companies that are growing their dividend payout year over year. So the next metric I would look at is the dividend growth rate. For VICI, that's a 10% growth rate, and they even increased their dividend payout during the pandemic, when most REITs were slashing their dividends. So this is a phenomenal thing to see. As a minimum, what I want to see is a dividend growth rate of at least 3%. Higher the number, the better it is. Just like when you ask a woman how tall they want their man to be. And according to this new generation, anything under 6'2" is now labeled as a short king. Or perhaps their perception of height is warped because every guy has been lying about their height. Next, I take into consideration the company's free cash flow history, or in VICI's case, because they're a REIT, the AFFO history. This is important because it tells a story about the success of their operations in generating cash and how they are using that cash to grow. What we want to see in a perfect candidate is the AFFO, or free cash flow, to be going up in a positive trend, or at the very least to be stable and consistent. With VICI, it looks like their AFFO is increasing year over year at a very aggressive rate. Kind of like your cousin's service dog that is a pit bull. Let's be honest with one another. She just bought him a vest off of Amazon and slipped it on for him. He isn't a real service dog, and you wouldn't dare be in the room alone with her pit bull because he is known for biting toes. I feel sorry for real service dogs that actually went through training and got certified because there's so many stolen valor service dogs roaming around at your local Walmart. And to clarify what you are seeing on your screen right now, in 3 quarters in 2023, VICI has pulled in $2.1 billion, and they still have one more quarter to report, and I think that's coming up in February, and the estimation is going to be $646 million of AFFO. And when you take that into consideration, the total AFFO for 2023 should be roughly around $2.75 billion. When you compare that to the year before of $1.69 billion, I cannot lie. I did not have relations with that woman. And on another note, that is a phenomenal increase in numbers to see. Next up, I would look at the compound annual growth rate, otherwise known as the CAGR. This is the year-over-year total return you see when the profits and dividends are reinvested into the portfolio. A high single-digit number like 9% or even double-digit numbers is what you want to see. If a company has a negative CAGR or a very low number like 1%, then it's a red flag in my humble opinion. They're hardly even growing. Speaking of opinions, can you believe for this presidential election cycle, it's most likely going to be Trump versus Biden again? Anyways, for VICI, their year-over-year CAGR is 14%. That is really quite nice, to be honest. Kind of like the first time I had Chipotle back in 2003. I never had Mexican food until that Chipotle burrito. And I'll just say this, my mind was absolutely blown at how delicious a burrito was. 20 years later, I am actually glad there isn't a Chipotle near my workplace because I would be eating there for lunch every single day. Although they have been getting a little stingy with their portion scoops these days. And for that reason, I think Panda Express is underrated. Can you tell I'm hungry and I haven't had dinner yet? And last but not least, I compare the current trading price to the Wall Street analyst price target to see if the company is trading for a fair valuation or is grossly undervalued. Wall Street believes that VICI should be trading for about $34, whereas it's currently trading for about $30. So I would say it's a little undervalued. Now, I think we should all keep in mind that this list is just the bare minimum. You will want to do a deep dive in other areas that you consider important. Some people care a lot about company debt, others don't care. Some people care about social and environmental factors, others don't. Some people also care about not wearing outdoor shoes into their beds, like me. We don't wear shoes in our household. I'll never understand the people who only wipe their butt a certain number of times instead of wiping until there's no more brown stains on the toilet paper. I guess some people enjoy walking around with a crusty butthole all day. On a side note, if you haven't invested in a toilet bidet yet, you are missing out. I will admit, having water squirting into your little butthole is a weird sensation, but it makes for a cleaner experience. Hey man, what about the dividend yield? Consider the dividend yield last. Please, if a company hits the mark for every other metric and has a juicy dividend yield, then, my friend, you might have found a winner. If a company has a juicy dividend yield but is a terrible company otherwise, you might want to avoid it. That's not financial advice. You also might want to avoid thinking about that one mistake you made over 20 years ago. It's time to let go so that you can finally move on with your life. Forgive yourself, because I doubt you are the same person anymore. If we prioritize and infatuate ourselves over a company's dividend yield, then sometimes we turn a blind eye to their other flaws. That's why I look at the dividend yield last. As for me, as long as the company pays a dividend, I'm a happy camper. Of course, I have a preference. A dividend yield of above 2%, that would be great. However, it's not a deal breaker if the CAGR is double digits. So what do I think of VICI? I think their finances and dividend numbers look great. Their dividend yield is above 5%. The payout ratio looks phenomenal. The CAGR is awesome. They passed the test on the surface level. With that said, this is going to be surprising. I'm not bullish on their industry or too hopeful of their future. Maybe VICI will prove me wrong. Maybe Las Vegas, casinos, and bowling alleys are the future. As for me, I think there's better opportunities out there. If you like VICI, it makes sense, and I can see why. It's got the right traits and history to back it up. I'm just not a fan of their story. You can call me petty, but in my defense, I think VICI's great. I'll say it again. They're great. Anyways, this is Dividend Compounders with Cheese signing off. Stay safe. Bye-bye.